Today I want to talk about the great shift in the housing market. Super interesting, I think. So I've been in the mortgage industry since 2001, and I saw the pre-boom, the boom, the bust, the recovery, and whatever we're going to call this next thing. But what I've seen in our housing market is that history generally does not repeat itself in the same fashion in the United States, because generally we learn from our mistakes and then something else occurs that we're like, where did that come from out of left field, right? So I think we're going to have some issues in our monetary system with our money flow and with the value of our dollar. But I don't think we're going to have an issue with a market crash. And I'd like to explore that a little bit more and break it down for you. So when we think about timing of the market, you can't time the market. Investors always say that. It's not about timing the market, it's about time in the market. And when you think about interest rates, the average interest rate over the last 50 years has been 7%, 7.63 to be exact. So if that's the case, we are at 5.5, 5.75, 6%. We're at historically low rates compared to what it was before. Only surpassed by a great pandemic that hit the world and a mortgage meltdown debacle that hit the United States. So within that, there are some similarities to the boom and bust that we should talk about. Back in 2007 and 2008 and prior, there was huge demand. People were overbidding on houses. They were making appraisal guarantees. They were paying over asking price. And there was a lot of things like lotteries where new construction, you were being picked for the opportunity to buy a house. There was also rising house prices pretty dramatically and pretty quickly. So house prices were increasing. There was a lot of low inventory, a lot of excess demand, so way more demand than there was available houses. And also there was fears, economic fears of the of not having jobs, and then the crash happened. But two key components that the crash had that is different than today was within real estate and within loan programs. So the two things was, number one, there was these loan programs that were available for real estate and for loan officers and for clients. For example, there was a NINA program. It was a no income, no asset loan. So you didn't have to have any income documented. You could just state your income, and you didn't have to have any assets stated. You could just get your money and show up to the closing without documenting where your money came from. And then there was things like Ninja loans. So they had these different types we had these different types of loans in the market, in the United States market, that were allowing people to buy homes with very little to put in. For example, you could buy a home one day out of bankruptcy, one day out of a Chapter 7 bankruptcy with a 580 credit score with 0 down. I remember those days. 0 down, 580 credit score, and one day out of bankruptcy is a recipe for failure, because 1 out of every 6 will default. 1 out of every 6. I think that's 17.67%. Would you want to lend out money knowing that 17%, 18% of your money is never going to come back? That's a bad deal. So the number two thing that was happening was we were taking these mortgage-backed securities, we were taking these garbage loans, and we were hiding them in our AAA rated paper. And then we were selling them to the American people and to people overseas, called mortgage-backed securities, AAA rated paper. That wasn't really AAA rated if you have these garbage loans intermixed in them. So then what was happening was loans were defaulting at 10%, at 15%, then at 20%. We were having foreclosures in the double digits, folks. And when that happened, the people in Abu Dhabi were like, what is going on? We don't want to buy your mortgage-backed securities anymore. What are you guys doing? How are your AAA rated paper that have less than a 1% default ratio, like 0.2% default ratio, how are they going belly up? We don't get it, but we want out. Yeah, and the housing crash happened. Today, the foreclosures are 0.2%. That's the amount of foreclosures that are in the United States. 0.2%. That's a far cry from double-digit foreclosures. Yeah, for sure. So those are a couple things that are lending to the reasons why I don't believe that there's going to be a crash. Now let's talk about the key differences. What is different today that was not there in place in 2007, 2008? Well, number one, 45% of homeowners own their home free and clear today. 45%, that's pretty huge. As I said before, foreclosures are at 0.2%. That's a huge difference from the double digits. There's not enough inventory. That is a key component that didn't exist prior to. Not enough inventory. Why is that? Because 15 years ago, after the mortgage crash, builders stopped building homes and they haven't recovered enough. They haven't built enough homes today to make up for the shortage. So why is that? Because the house building is expensive. It's extremely pricey to build a house. There is not enough builders in the marketplace. When builders do come in, they're having some employee problems, so cost problems and employee problems. In just 1 year, the average sale price, the average equity increased by $64,000 according to CoreLogic. That's just in the last year. There's low unemployment that is existing currently, and we didn't have that prior to. And another key component that I just looked at and remembered is that Fannie Mae is limiting the number of investors in their portfolio, Fannie and Freddie, where we get all of our conventional financing, to 7%. That means they're not allowing more than 7% of their mortgages to be comprised of an investment property. So they don't want a ton of investors buying properties and having mortgages. So if you are an investor and you're buying houses, you are either putting a lot of money down, usually at least 25%, or you're paying cash for that house. So these are some key differences that are causing, that I believe will not cause for a market crash. All right, this next thing I like to talk about is some statistics. So leveraged investments. Number one, what you should know is that if you're a homeowner, you are 50 times more wealthy than a person that is not a homeowner on average. 50 times, that's huge. I want to talk about the concept of leveraged investment and what that means. Remember, it's not about timing the market, it's about time in the market. So let's talk about that on an extremely conservative, about some statistics. I really like this. If you are a homeowner, you are 50 times more wealthy than a person that is not a homeowner. That is the industry average and the facts. And remember, according to CoreLogic, the average equity went up $64,000 just in the last year. So what I'm going to talk about next is called leverage investment. You have to be a homeowner or an investment in real estate in order to build wealth, I believe. Let's talk about that a little bit deeper. Let's say you buy a home, a modest home, for $200,000 and you put 10% down. That's $20,000. On average, a very low appreciation rate would be 3%. 3%, you bought your home for $200,000, so after year one, your value of your home goes up $6,000. Then after 3 years, it goes up $18,000. And after 5 years, it's gone up $30,000. Remember, your original investment is your $20,000. You do have your mortgage payments, and that's building up extra equity as well, and you're paying those mortgage payments. But aside from that, you put $20,000 in. That was your investment. After 1 year, your value of your house went up $6,000. You just made 30% rate of return on your money. You put in $20,000, your increase is $6,000 because you get value on all $200,000. Your value is going up on all $200,000. It's increasing. So after 3 years, your home has gone up, as we said, $18,000. That is a 90% rate of return on your money, 90%. And after 5 years, with your home value going up $30,000, you just made 150% on your money. Where else can you do that? And if you increase your payments and you pay extra on your loan and you pay your loan like a 20-year mortgage or a 15-year mortgage, your equity is building even faster. That is what a leveraged investment does. So even if you put 10% down, you see rates of return of 30%, then 60%, 90%, 150%. And if you put down a low interest rate down payment of 3%, or 3.5%, you're seeing those increases even higher. Right on. Totally awesome. And that's how real estate works. So it's not about timing the market, it's about time in the market. So recession. Recession is defined by 2 quarters of low GDP. And we have to admit, we've been through 2 quarters of low GDP. So technically speaking, we are in recession. A recession is not tied to the housing market. In fact, most of the time, it's very unlikely and it's very opposite. For example, in the Depression time, only 1 of 10 people owned a home. Only 10% of home ownership. Back in the Clinton administration, it rose to over 70%, which was scary times because not everyone should own a home. Some people it's not appropriate that they own a home because they don't make enough income, or they don't have the credit, that they don't have the spending habits that warrant them being able to make those payments over a long period of time. So a healthy market environment is home ownership between 60 and 65%. With that being said, it's important to know that with this time of recession, after we've been in recession for a while, you will see the government come back in and lower interest rates. So I believe in the next 18 months, interest rates will most likely be lower. It's possible. Why is that? Because the government will come back in and try to spur the GDP and spur housing again with refinances and home purchases. But for now, that's not needed because we have high inflation. So high inflation, you offset it by increasing interest rates to combat that high inflationary period. So in totality, what I have to say is now is a really good time to buy a house. I don't feel that there is going to be a crash coming. There's not going to be a housing market crash. There's not the data and the statistics that support that. At the same time, we are seeing a leveling off of home prices, which is good because a stable market environment is one that house prices increase 5% a year, year over year. So it's speculated that by the end of this year, we'll have seen on average that house prices increase 8 to 10% this year, and next year it's predicted that they'll increase about 5%. And so that's much more of a stable environment and one that you can rely on. So remember, it's not about timing the market, it's time in the market. And if you want to get wealthy and build wealth, you've got to do it through home ownership and then leveraging other investments. I'm not saying that a 401k is not a good idea and other investments aren't a good idea, but you want to have a nice mix. And real estate is definitely part of that mix. Thanks for watching. Have an awesome day.